our earnings model, which, as you know, we spend a lot of time focused on, the spread between our forecast now and what the consensus is modeling for next year is as wide as we have seen since the summer of '08. Okay, so in other words, we're looking for an earnings recession that could be as big of a surprise to the market as it was in '08. Now, what we're not looking for, and I'll make it perfectly clear on this, is a balance sheet recession, a systemic risk fall off like we saw in the fall of '08. So it's very distinguished, but it doesn't mean that there's still not a lot of price risk here. Okay, this is where we think we're out of consensus now and where we have high conviction. So a year ago, it was really about the Fed and the normalization of rates. And now this is the second part of our thesis. As you know well, the ICE part is now really kicking in. And there's this sort of presumption out there from our conversations with clients that everybody knows that earnings are going to be bad next year and the market's already priced it. And we're just putting this warning out for folks who assume the market is omnipotent and it knows this. The market typically doesn't know these types of earnings declines before they happen. So that's the risk now, if we're right. Okay, we have conviction in our view. We could be wrong about that, but that's our work. And we think this rally that we've had, which we identified and then got out of 2 weeks ago, we think that the technical price action last week was confirmation that rally is not only over, but it's about to exert itself on the downside again in a meaningful way. Our forecast I'm talking about is for the next 12 months. Everybody focuses on this quarter, but the market doesn't care about this quarter's earnings. It never does. It cares about what's going to happen over the next 12 months. That's what the market really focuses on and tries to figure out. In our model, we've got 30 years of history of this thing. It does a really good job of using data that's already out there, mostly top-down data. Some of that's survey data, soft data, as we like to call it, that leads to hard data. And, the R squared on this thing is 80%. So it doesn't mean it's infallible, but it's pretty darn close. And when the spread is this wide, you really want to pay attention to it. When the spread's 5%, it's like, that's kind of noise. The spread's 25%. So that tells us that, this is probably not in the price. We've been very consistent about that, right? I mean, we've been in this sort of 3,000 to 3,300 range since really May. We put our mid-year outlook out. That's the path. And we think that's still the path. And I would say that we now believe we could get to the lower end of that path simply because you worked off kind of this bearishness in the last 2 months. I mean, the bear market rally we had did its job, right? Its job is to, it's like a 3-card Monte. Look over here, and then all of a sudden you forget about looking over on this one. And then that's when you get surprised. So, the setup's good for a finishing move to this bear market. That's the bad thing. The good thing is we're closer to the end than the beginning. We've been bullish on bonds since the summer. We were probably a little early on that call, but it's worked out pretty well. The Fed cannot be as accommodative, right, as they have been historically because of this underlying inflationary issue, which is new in the investment community for the last 30 years. So that's one other thing we'll be watching closely in the spring. How fast does the cavalry come riding in, even in the event of a labor cycle? I think they're going to be slower. They've told us that, and that can be the surprise and why we can get to those lower price levels on the S&P 500.
The Fed and the CPI, that was the story in October. It's interesting, the price action, right? So in October, the downtick in CPI was a surprise. We got a big rally off of that because rates came in. But to think you're going to get another rally on that news, I think is, a bit naive because you already had it, right? You're going to get another rally on that. So I think what we can say about this week's data, CPI's peaked, inflation's peaked. We're pretty confident it's going to come down pretty hard next year. And the real question is, what does that mean about growth? And that's the second part of our bear market story that we've been talking about for almost 12 months now. The growth slowdown is not yet priced. And that's what's going to determine the winners. Like, it's a stock picking game. I mean, there are going to be some companies that deliver on that. But the index level, we're pretty pessimistic that we can support these prices given our outlook on earnings next year. That's right. We're not looking for a 5% miss. We're looking for 15 to 20% potentially. It could be that significant. Now, the good news is that most investors agree, okay? Like, the market, this is not new news. I mean, people assume earnings are going to come down, but it's the magnitude of that decline and how fast that's going to happen. We think that's where the surprise is, that the negative operating leverage that we see from falling inflation, by the way, is what's going to hurt margins, and that's irrespective of whether we have an economic recession. So I would say some companies are already in an earnings recession. So what we know is this year, every quarter has been disappointing, but we haven't yet gotten the guidance on 2023 because companies have no reason to talk about 2023 until we get there, right? They keep deferring that. But in January, they're going to have to address that. And that's why we think this is the quarter we'll get a bigger step function lower on forecast for 23, and that will create the final, kind of plunge on multiples that can give us a real buying opportunity. We felt like the rates were going to come down, that the Fed is yesterday's news. I mean, this is now known. I mean, the bear market has been driven by Fed policy, higher rates, concerns about inflation, multiples have contracted. So we got relief on that, and that's why we rallied. But that's a trade because ultimately stocks will care about the earnings decline as much as they care about the Fed pausing or even continuing for another couple of months.
Said we were going to be ending financial repression in the next recession, and of course the pandemic, provided the perfect setup for that because the fiscal stimulus got blown out, and that's really what led to the inflation boom. And this is where I think we have a very differentiated view from a lot of our peers, which is we don't think it's the 70s. We think it's more the 40s where it's a boom bust. And what I mean by that is it's a demand pull inflation as opposed to a cost push. And therefore, inflation can ebb as quickly as it flows when demand falls by the wayside and supply picks up. And that's exactly the setup that we see for 2023, right? You have easy comparisons. Supply is picking up now. Demand is fading at the same time. And look, we just go back to Milton Friedman's, original quote, inflation is a monetary phenomena, and M2 growth has plunged, right? We were 27% growth year over year in the first quarter of 21, and now we're down to about 2.5. So, that's a leading indicator. And that's just a different environment than we've been operating in for the last 30 years, where everything was so predictable, right? Whether it's inflation, whether it's other economic variables, we're going into an environment now where an economic variable volatility is going to be extreme. And that's a difficult operating environment. And, some companies will do a good job of that and some won't, but it creates probably a lot more dispersion, quite frankly, across the stock market. During the pandemic, right, companies over-earned. Some of that was obviously with excess demand, but a lot of it also had to do with inflation. Companies had extraordinary pricing power, and they had tremendous operating margins. Now we're seeing the opposite of that, where costs are actually increasing more than end price components, and that leads to margin compression, so negative operating leverage. But just got to remember, on the other side of that will be another boom. So as bearish as we are on 2023 for earnings, we're actually probably more bullish than most for 2024 based on that thesis. Now, we don't have a crystal ball, but look, we've been talking about this for several years now. We think it's been playing out. And you're exactly right. If you understand this, and by the way, you have to agree with it. If you understand this, it can be a very profitable environment for investors to just be more tactical around these swings in economic activity. And that's how we're going to trade it. That's what we do. We're cycle analysts, and this is actually kind of a sweet spot for us, the way we look at the way we manage money. For our core, kind of view, we remain of the view that the bear market is not over, primarily because of the view we've had all year, which is that earnings ultimately will decide the end of the bear market. And we think earnings expectations for next year are significantly too high, maybe as much as 20%.